Hi, I'm Cheryl Hassan. I'm a mortgage broker. When I first meet new customers, I like to get to know them. One of the questions I ask is who do they do their current banking with? And what's the good, the bad, and the ugly of that bank? I also like to ask whether they're happy to look at other banks for their lending. The answers are always diverse, and the reasons for the answers interesting. Customers are either loyal to their current bank or happy to go with another bank for new lending who will give them the best deal. Particularly our Generation Y, who seem to be so much more fiscally in touch. Gen Y understand that banks are just another shop that provides goods and services. There's no brand loyalty because they can't see the benefit of keeping everything in one spot, except to the bank itself. Like shopping for a new pair of shoes, Gen Y shops around and changes the bank to suit their needs. I also noticed that the Gen Y are more likely to have online savings accounts with banks that only have an online presence, in exchange for a much better interest rate. So, is having everything with the one bank smart or not? There are, of course, reasons to stay with just the one bank. There's simplicity to your banking. No multiple logons to remember. There might be discounts offered for a complete customer or a customer who has everything with that bank. And there may be special offers which are only available to current customers. If you choose to have your home lending and banking and everything else with the same bank and in one place for the reason of convenience, then it makes sense. However, investor, is this the wisest choice? A serious investor will understand the benefits of diversity of their mortgage providers. But why do some investors still have their lending at the same bank? Customers will say, one, that it's for convenience. My thoughts are this is comfy couch syndrome or laziness, and in some cases they just lack the knowledge that the banks are just reinforcing the benefits to you and you're believing it. If you, the investor, think you are getting a banker who is personally looking after you and getting you a better rate for your portfolio if it's big enough, then that's just a myth. Although I took several personal customers under wing when I was in banking and did keep an eye on things for them and look at future strategies and not just at the loan application that was in front of me, it's not the norm. Banks are risk-based and they assess their exposure to risk. In reality, if you have a large amount of lending, you are likely to be watched more closely. Not to take care of you, but to ensure that there's no signs of financial stress and even the type of investing that you are doing to ensure that it still fits their appetite for lending. As such, your financial institution has the ability to decide whether your investment strategy goes ahead, stays the same, or can even be reduced. That's right, they can decide that your type of investing no longer suits their appetite and can give you notice to refinance. Now imagine this happens at a time when markets have declined and your lending could actually be more than your asset position. No one's going to want to take your loans. Suddenly, you're in a position of selling your portfolio at a loss and your investment future and retirement strategy has been ripped out from under you. What if you're self-employed and your major supplier or company you subcontract to hits hard times? As a flow-on effect, through no fault of your own, you're unable to meet your debts. If you would like to renegotiate the terms of your lending, they will look at all your loans, not just your owner-occupied home loan. So what's the answer? Well, different banks for each property. Have a financial broker assist you with your strategy for now and for the future. Without this diversity, your portfolio is at risk, you are probably paying too much in interest rates, and you are not actively taking notice of your lending because you think your bank is. It's not. What if you can't change banks? The truth is, sometimes strategies such as cross-collateralization are used. This enables you to use equity in your property and avoid mortgage insurance. And all the loans and security properties are all tied up. At the time of the purchase, this may have been the only option. It's not wrong, it's just not forever. Understandably, it's easy to throw your hands in the air and go, it's too hard. But don't forget, this may have been the case when you first did it, and the lending, and now with the property values increased, your loan to value ratio position will have improved. Now is the best time to start reviewing and pulling these loans and securities apart and sorting this out so each home is standalone as the only security for each loan. This is not a position you're stuck in forever. So book a financial health check with me. What are the benefits? Well, the benefits of doing this is the ease in refinancing a single property at any time because each loan has a different financial institution. You can refinance one property wherever and whenever you like, provided it's not a fixed interest rate loan, there's no break costs involved, and you don't have a clawback fee from a broker if it was done through the broker. You also have ease of taking up new customer-only special offers from banks with new mortgage portability because you have a number of lenders in your investment portfolio. And don't forget, a lot of offers relate to new lending only. No bank is going to always be the best bank for products, rates, services and fees. Review them regularly. There's also bank policies. All bank policies are different with each bank. So if you have your loans at different banks, you're not subject to one policy. If you want to release equity in a property and your bank only has a 90% loan to value ratio, other banks might have a 97% loan to value ratio. There are also postcode risks. Your bank may decide not to lend to a certain postcode, whereas a different bank will. Bank policies vary. Your bank should be selected on your needs for this loan. Every loan does not fit in the box of every bank's policy. And what about capacity to borrow money? Each bank has its own calculator, and this calculator works out how much you can borrow. Some banks are easier to get lending with because they don't load their rates for existing lending. For instance, if you have a car loan and it might be currently at 12%, the calculator assessing it might assess it at a 14% debt. Because your bank says no doesn't mean other banks will. Get a good broker to work with. What about rental income? It's assessed differently by different banks as well. If you have a portfolio which is producing most of your income and you need to go with a bank who is assessing the income at the highest percentage, just because you rent your property at $500 a week doesn't mean the income's $500 a week. Banks will take a percentage of this income for future lending assessment. And what about personal debt? Keep your personal debt separate from your investment debt. Your owner-occupied home loan should be at a different bank to your investment lending. This gets more important as you cycle through from PAYG income to investment property income and makes it easier for your accountant. Credit scoring is also another one. Not all banks credit score. If you've actively been involved in wealth creation, you may have a very busy credit file. You need to know that your bank is working with you and that this loan suits the way they are working so that you can gain financial control, freedom and security. And what about borrowing in different structures? Not all banks like structures. As your property portfolio goes into a few different properties, you'll want to start looking at borrowing in structures such as a company and trust structure. This is also great for asset protection. Not all trusts are the same and not all banks like the trusts. And what about self-managed super fund lending? Not all banks are going to lend to a self-managed super fund, and this may become part of your investment strategy in the future. The percentage that banks lend and the rules that apply to self-managed super lending vary between the banks, and you need a bank who's going to do the deal for you. So what to do now? So don't just sit there, be actively involved in your financial future and your investment strategy. Book an appointment to review your lending and do a financial health check with me. Make sure your accountant is an accountant who works with you for your investment and wealth creation strategy. Review your lending and your security position and do this regularly. Do, at the very least, separate your bank that has your principal place of residence mortgage and your rental property mortgage. Do discuss whether having a company and trust structure is for you with your accountant. And speak to me about unlocking the potential of purchasing an investment property in your self-managed super fund. If you have any questions, please email me or give me a call or send me a message on Facebook. Thanks for listening.